You're tuning in to The Deep Dive. Today, we're getting straight into it.
Yeah, let's do it.
We've sifted through the latest company earnings calls, investor decks, analyst reports, all that good stuff. And our mission, really, is to pull out the most important bits, the interesting insights on how things went last quarter and, what's coming up.
Right, without drowning everyone in numbers.
Exactly. Just the crucial takeaways.
Okay.
Okay, so what did we find?
Well, I think the first thing that really jumps out is just how resilient the core business aims to be. Despite all the talk about the economy, they reported 8% FX-adjusted revenue growth in Q1.
8%, wow.
Yeah, and actually, if you strip out the leap year effect, it's closer to 9%.
Okay, so even better.
Pretty much. And importantly, this lines them up nicely with their full-year guidance.
Gotcha.
And their total billed business, which is, a good forward indicator, that was up about 7.5% year over year, adjusted. So actually a bit stronger than their overall 2024 growth.
Interesting. So where's that spending actually happening? What are the big trends you saw?
So there are some interesting shifts. Spending on goods and services actually picked up some steam compared to last year.
Yeah.
Travel and entertainment, T&E, that's still a really strong area, holding steady at those high levels we saw, for most of last year.
So you're going strong then.
Definitely. And within T&E, restaurants and lodging were particularly robust.
Right.
What's kind of interesting, though, is airline spending growth did decelerate a little bit compared to 2024.
Oh.
But the demand for premium seats, front of cabin, that's still really high, up around 11%.
Huh. So people are still splashing out on the fancy seats, even if overall airline growth slowed.
Seems like it, yeah.
And are we seeing, different groups spending differently?
Oh, absolutely. Affluent consumers in the U.S., their spending was up 8%.
Solid.
And here's the key thing. Millennials and Gen Z are actually driving the highest growth within that affluent segment.
Really shows their increasing impact, doesn't it?
It really does. And internationally, their card services spend jumped 14%. Big double-digit growth in their top 5 markets.
Wow. Okay.
Commercial services was a bit more steady, up 3%, pretty consistent with how 2024 looked.
So it sounds like spending's holding up, but they're also bringing in new customers too, right? Not just relying on existing ones.
Exactly. They added 3.4 million new cards just in the quarter.
That's a lot of cards.
It is. And thinking about the future, over 60% of their new consumer accounts globally, Millennials and Gen Z.
60%.
Yeah, it really shows they're connecting with that younger demographic. Plus, get this, card fee growth was up 20% FX adjusted. 20%. That marks the 27th quarter in a row of double-digit growth there.
Incredible consistency.
It really suggests people see value. They're willing to pay those fees.
Yeah.
And yeah, retention is still holding high too. Always good.
Okay, so the customer side looks strong. What about the lending part of the business?
Right. So on the lending side, their loans and card member receivables were up 7% year over year, FX adjusted.
Okay.
And it's really their premium products driving the pay over time features, the co-brand cards. They accounted for something like 80% of the growth in revolving loans.
Got it. With lending picking up, though, how's the risk looking? Is credit quality holding up?
Yeah, that's obviously key. And honestly, the numbers look pretty solid there, too.
Yep.
Delinquency rates, write-off rates, they're still below pre-pandemic levels and pretty much flat year over year.
Stable, then.
Very stable. And what's quite interesting is for their newer customers, like under 24 months, their delinquency rate is about 30% lower than it was back in 2019 for U.S. consumers.
30% lower. That suggests pretty good underwriting.
It does, yeah. They seem to be managing that risk well. Their provision expense was $1.2 billion, and that actually included a small reserve release reflecting, their view on portfolio quality and the economy at quarter end.
Reserve release. Okay.
Yeah.
That signals some confidence.
And just quickly, net interest income was also up 11% FX adjusted. Grew a bit faster than the loans themselves thanks to a better net yield.
Okay. And expenses. Always a focus.
Right. Their VCE to revenue ratio was 43%. Rewards expense grew 16% year over year, but that was mainly due to a comparison with some model changes last year and a few small program tweaks.
Got it. So that paints a pretty positive picture for the quarter. Stepping back, what are the sort of key business highlights they stressed, and what's the outlook?
Well, they're really hammering home the strength and the resilience of their whole business model.
Okay.
They talk about this global premium customer base that's getting, even more premium.
Right.
And a big point is their diversified revenue. About 75% now comes from spend and fees, not lending interest.
Makes sense. Less reliance on lending cycles.
Exactly. Makes them potentially more stable. And they also highlighted, their expense flexibility.
There was some chatter, wasn't there, about whether people maybe spent a lot early in the year pulling demand forward. Did they address that?
Yeah, they did directly. They said they see absolutely no evidence of that.
None at all.
Nope. Spending levels through early April were apparently consistent with Q1 across goods, services, customer types.
Yeah.
They even had their highest ever number of travel bookings in March, including international.
Wow, record bookings in March.
Yeah. And they also made a point that card member spending doesn't seem tightly linked to, say, the stock market or consumer confidence numbers. Suggests something more fundamental driving it.
Interesting. So even with maybe some economic uncertainty, they're still investing for the future.
Absolutely. They were clear about committing to long-term growth. You saw the recent acquisition of Center.
Right, for SME expense management.
Exactly, bolstering that offering. Plus, continued investment in tech infrastructure, and they keep refreshing products like every 3 or 4 years.
And sticking with their financial targets for the year. Guidance maintained.
Yes, 2025 guidance is unchanged. Still looking for 8% to 10% revenue growth and EPS between $15 and $15.50. And it's worth noting that guidance includes their expectation of a peak unemployment rate around 5.7%. So they've factored in some macroeconomic assumptions.
Right, got it. We mentioned Millennials and Gen Z earlier. Still a big focus.
Oh, huge, huge focus. The strength they're seeing there, both in acquisition and spending, is significant.
Like how much?
Well, in the U.S. consumer business, spend growth for that group was around 15%. Internationally, 22%.
22.
Yeah. And what's really encouraging for them is the credit quality delinquency rates. FICO scores for this group are actually better than industry averages and better than previous cohorts at the same stage.
That's definitely promising long term.
Very much so.
And finally, any word on returning capital to shareholders? Dividends, buybacks.
Yep. They're targeting a CET1 ratio, that key capital measure, between 10% and 11%. And they bumped the dividend up by 17% in the first quarter.
17% increase. That's a strong signal.
Definitely signals confidence.
Okay, so bringing it all together, sounds like a really solid quarter. Good performance, strong customer trends, holding guidance, even with, maybe a bit more economic uncertainty, and still focused on the long game.
That sums it up pretty well. And, maybe this leads to the sort of provocative thought for listeners to chew on.
Okay.
Given everything we've just discussed, their focus on premium customers, that shift towards fee and spend revenue away from just lending, how might that uniquely position them compared to competitors, especially navigating whatever economic climate comes next?
That's a great question.
Yeah, like what potential challenges or maybe even opportunities are out there that weren't explicitly laid out in these reports? It's definitely something to think about, the bigger strategic picture.
Absolutely. Food for thought indeed. Thanks for breaking all that down.
Wondering how we quickly synthesize info for this podcast? We use AI. You too can boost your productivity with AI thanks to our sponsor, BrainyBeeApp.com. Get instant answers and insights using top AI models like Google's Gemini, Claude 3, and the latest from ChatGPT. Stuck on a tough calculus problem? Snap a picture for an instant answer from Brainy Bee. Need a deeper understanding? Ask Brainy Bee for easy step-by-step explanation effortlessly. No subscriptions. AI for business, AI for fun. Skip the subscriptions. Brainy Bee is #1.